Hello, everybody. This is Michael DeGioia with the Dash Trader Newsroom. And will the markets continue to correct? If so, how low will they go? My name, as I mentioned earlier, is Michael DeGioia. I'm the Director of Educational Services here at Dash Trader, and I'm a licensed professional. And I'm joined by my co-host at the Nasdaq market site, Jill Malandrino, Global Markets Reporter at Nasdaq. Jill, how are you?
Good, doing well, thank you. And to your sentiment, if we knew which way it was going to go, we would be sitting on an island right now, wouldn't we, Mike?
Okay, higher interest rate expectations are leading some market professionals like Ray Dalio to indicate that the stock market might correct up to 20% from here, from these current levels. What are your thoughts on that, Jill?
Yeah, you know what, Mike, it was a really interesting week of trade, and the move that we had down on Tuesday from the CPI data, to me, I thought was, I don't know if it was overdone, but it was a bit shocking. It's not as if there's been a deviation from policy change, and I would also argue that a lot of it was algo and machine driven as well, just to see the flush that we had experienced. 20% from here, I think first we have to test the lows before we even start thinking about that. But I think it's kind of hard to make these predictions right now, especially when we're in earnings season vacuum. We don't have corporate data to look at. We don't understand how management teams are approaching inflation and potential business slowdowns. And you and I have spoken about this before, but I also think that we need to impress upon people that for at least the past 10 years, we've been in a market that has been up to the top right of the chart. And sometimes when you hear these are abnormal markets, these are unusual markets and so forth, well, that's not the best term for it. I think that's almost doing a disservice to investors. Markets do go up and down. It is unusual to have liquidity injected into the system like we saw over the past 10 years. It is unusual to see rates as low as they were for a number of years. So, ups and downs in the markets, ups and downs in the economic cycle are supposed to happen. So I think to make these extreme calls from one end to the other, you're rolling the dice at the end of the day, regardless of how successful your investor you are.
Got it. Yeah. Certainly, from a technical perspective, I can see what he's saying, and those levels, we'll go through those later on the charts. But yeah, you're right. These are unusual times. I mean, we have pretty much had, I think it's almost 12 years of quantitative easing, and now we are starting quantitative tightening. So really, it's anybody's guess at this point what the markets will do if those lows are broken. And the retail sales numbers have come in lower than expected, indicating that consumers are having trouble keeping up with inflation. Also, credit card debt is soaring, meaning that people are using their credit cards, swiping those cards up and down, or inserting their chip, or passing their phone over, whatever, to kind of keep up with the rate of inflation. The question is how long will they be able to do that, as inflation does not seem to be relenting? And certainly we're going to be watching next earnings season to see what the effect of this kind of piling up of consumer debt. And of course, the numbers are already showing to be declining in the retail sales numbers. So what are your thoughts on the retail sales numbers and the increase in consumer debt that we're seeing?
Yeah, well, it's interesting when you take a look at the data. The luxury market typically can weather most of these storms, but what you're seeing is, a downtick in consumer discretionary spend. And, the concern here is using credit card debt in order to afford the essentials. If you're paying for gas, paying for food, paying for back to school clothing, potentially using it to pay month-to-month utilities and services. That's really what the concern is, because at some point you run out with that option. I also think, it's been a while since we've spoken about this, but again, with less liquidity, you don't have stimulus checks, you don't have, forgiveness like we saw over the past couple of years. Did people save? Did people allocate it towards discretionary spend? So I think the cycles it's so hard to compare a year, over 2021, over 2020. It was such an anomaly with moratoriums and rent and student loan payments and forgiveness. And now we're back into what's a more normal environment, if you will. So, the only thing I can recommend, and we've had a number of credit specialists on our show, that, the most important thing you can do is focus on debt management more than anything else. And there are, you don't be afraid to call your credit card companies and help negotiate with rates or with payments and so forth, just so that you can kind of keep your head above water until we see some of the inflation come out of the system. And on that note, Mike, just because we raise rates doesn't mean that the inflation situation has changed overnight. It's a process. Investors, consumers are going to need to be patient. You're looking at, a good 9, 12, 18 months here. So I think, managing debt and keeping your expectations in check is going to be key when thinking about your investment strategies.
Yeah, I think that's a really good point, is that the, credit card interest rates are ticking up as well. So, people should really call their, credit card companies if they have debt. They can sometimes negotiate short-term temporary reductions in rates to pay off balances, cut back spending to start paying off some balances and things of that nature, and kind of recompensate instead of just continuing to spend at the same level and just piling on the debt onto high interest rate credit cards. Certainly you have to be careful with credit, as it's always there when you don't need it and never there when you need it, as we say in the financial industry, right?
Yep. And it's funny that you brought that up, because, we also have another saying where it's like stairs up, elevator down.
Yes.
And it's kind of the same premise. Once you, fall into a tricky consumer debt spend situation, it's kind of almost, it's the same premise.
Absolutely, it certainly is. So on that note, let's jump to the next one, which is one of our favorite topics to talk about, is cryptocurrencies and the blockchain. This is a very long awaited, Ethereum has merged onto its new network. I guess it's like Ethereum 2.0 or whatever. But Ethereum prices have dropped as it completes its long awaited network merge. But what does the price, what does the future hold for crypto? Because it seems like Bitcoin is benefiting somewhat from this network merge. Bitcoin didn't necessarily react negatively. Instead, Ethereum's price has dropped a little bit. Obviously, we don't know what the long-term effects are going to be, but what are your thoughts on the Ethereum 2.0 merge and what the long-term effects will be in the crypto space?
Yeah, we have had a number of crypto and blockchain experts join us over the past couple of weeks leading up into the event. And of course, we know that you had the successful transition to proof of stake, and the way that the industry is looking at it more so than is to sell the news type of event, and the value of Bitcoin and Ethereum and other associated coins is more about the underlying infrastructure and how they were able to successfully do the merge. Because the key here is, it wasn't as if in other words, everyone tried to compare it to 1999, 2000, that feeling of anticipation, but it was in fact something very different, because this wasn't an update to a platform. This was an entire transition to a brand new platform. So there was a lot at stake here. This is why it had gotten pushed back for a couple of years. For that reason, it is something that, if it was unsuccessful, I think it could have been, regardless of what happens to the prices of different crypto assets, I think it's the concern about how the approach to the infrastructure will be. There's smart contracts that are on the chains. That Web3 and all the associated projects are being built off of this type of technology. So the fact that that was successful, I think that means more to the industry than the actual reaction of the price to the coins.
Yes, I think that from a market perspective, I'm glad it's out of the way, right? Like, it could have been disastrous for Ethereum had there been a problem. But since there wasn't a problem, at least that takes an uncertainty out of the equation from Ethereum. And yes, the price has settled back a little bit, but it wasn't a precipitous drop. We're going to take a look at the chart of Ethereum as reflected in the ETHE shortly when we go through the market analysis. And I think overall, this does show that you can transfer to a new network or merge onto a new network. I would say it was more of a merge than a transfer, because they pretty much were able to continue the old and still run the new, which is really the definition of a merge. And certainly, Ethereum is a newer, much more intelligent technology in some ways than Bitcoin, but Bitcoin still has that brand recognition as the old standby, kind of the Xerox of the cryptocurrency space. And again, it went through something like this similar when it did its, I guess it was about 2 years ago that they did I forget what it's exactly called, but needless to say, Bitcoin went through something similar about 2 years ago. And they also handled it quite successfully. And then, of course, Bitcoin took off after that. So
Yeah,
I think it's good that it's out of the way.
I think so too. And I think we need to understand that it was such a complex undertaking to take because, and arguably it could have been one of the largest open source software endeavors in history because you had coordination across dozens of teams, individual researchers, developers, volunteers. I mean, there's so much that runs on the Ethereum network. And the other point is, there's always been a concern around mining and how energy intensive the process is. The fact that this was successfully able to be done reduces its energy consumption by like 99.9%. And that's why this payoff could really be potential. I think I read somewhere it would be almost as if Finland had suddenly shut off its power grid, right? According to a couple of estimates out there. That's how much energy is being saved. And that really was
crazy,
the case against a lot of the mining here. So it was a massive undertaking.
Yeah.
I don't have the exact technical understanding, but I think it really is positive when you think about infrastructure adoption and how newer technologies are built moving forward.
Yeah, I mean, that's something probably most of the viewers don't understand is that one of the things, I started mining Ethereum very early on in 2016, 2017, and you realize that the Ethereum network is run on other people's computers. So like if you build a mining rig, you're running your Ethereum software to mine Ethereum on your computer. So by them merging to a new network, you have all these people who are previously mining Ethereum running new software on a new network. And really, I mean, it's a massive endeavor to get all these people that are involved in the network worldwide to kind of merge onto this new Ethereum 2.0 platform. And that really is a massive undertaking. It's great it's out of the way. And of course, one of the big problems that people like Elon Musk had cited is that it's incredibly energy intensive and that this reduces that concern. So thank you very much, Jill. I'm going to jump to the charts. I know you've got other meetings to attend to.
Yes.
So thank you so much. I'll see you in 2 weeks.
Yes. Awesome. Thank you.
Bye-bye now. All right, here we go. So this is my Dash Trader software running in all of its glory. So first things first, let's jump to the S&P. And I'm going to look at it. Notice we have all the hot buttons up here. And I can put on my, my S&P chart. And we are sitting right here at key support. So here we have a low, right? Retesting the prior low here. Okay, so there's a low and we're retesting the prior low from, this is just about 5 days ago. So this is 1, 2, 3, 4, 5, 6 days. So this is the low from 5 days ago that we're retesting. Now the big number, I mean, so if we break this low here, okay, we will go down and drop all the way down to the next low, which is at 371.50 on the SPY, which represents the S&P 100 ETF. And that would take us, so you usually would get another swing leg down. And I'm going to use my rectangle tool here. My rectangle tool here would indicate from that swing high to the current swing low. And if I take that and I move it down from that swing high to that swing low would put us to somewhere, an early bounce point, which would be here. And I'm going to put another horizontal line in there just to mark that early bounce point. That would put us somewhere in here, the support level that was delineated at 381. So 381 on the S&P would be the next swing low. And then if you have a rally up, what was previous support would become new resistance. That would be at 389 or 390. somewhere in that area. And then the next swing low would be down to 371 spot 50 in that area as well. The big major support here from the market sell-off and market correction would be down here at 364, 362, somewhere in that area. And I'm going to mark it off again with a horizontal line. And really, these are the key support levels. We got 381.24. We're right now at key support as we are looking at it, trading at the low of the day here on the daily chart of the S&P. And then you got 381 as the next level of support. Then you got 371, which is a whole 10 points down on the S&P. And then you have a 362, another 10 points down as the all-time low of the year. And I'm going to jump to the QQQ so we can take a look at the Nasdaq. And overall, the Nasdaq has been leading the market to the upside on the way up, and it's certainly been leading to the market on the downside on the way down. And we're at key support. It looks like we've actually broken the last support level, which was at 292. If we close down where we are now at 290, we would be closing below the support level, and that would be interpreted as bearish. Okay, and we have a head and shoulders pattern here on the chart. So that's again another bearish indication. The next level down on the QQQ would be to we're already kind of there, so I'd put us down here at this one. So the next level down is from 289. You have an almost 10-point drop, a 9-point drop down to 280, and then the next drop again, looks to be like about 10 points. Okay, which puts us down at 270, and that would be the low of the year. So based on these technical indications, it would be a very clear drop down from 289 to 280 down to 269, and that would bring us to the all-time low here of the year. Well, not all-time low in history, but all-time low of the year. Let's take a look at the DIA, which has been showing a little bit of weakness as well. It's got a head and shoulders pattern as well. And it's already had a neckline break. We had a very bearish gap down and very, very sharp sell-off from that gap down after a 4-day rally. We've already broken the support here. So I would say that the next level down, if we close at these levels, I'm going to say that the market's probably going to close at the low of the day. We only got 20 minutes left to go. So we got a possible close at the low of the day. You got a 10-point drop down to 301, and that would be on the DIA, which represents the Dow 30 ETF. And if we take a look at the major stocks, AAPL, we say so goes Apple and so goes the market. And certainly Apple, in its run up to the release of the iPhone 14, really sold off precipitously. And I've mentioned in the past that as Apple goes, so goes the market. Apple has been one of the strongest stocks. It's been holding up the market. And certainly the reaction to the new iWatch was really almost like the SE is still better than the new release. At least that's some of the reports that I've read. And that would be pretty bearish for Apple, as people aren't going to upgrade if they have a pretty good version. For instance, I think the iPhone 13 is great, so I probably won't be rushing to skip and buy a new iPhone for the iPhone 14. I don't see any real significant increases. I mean, there are increases and some improvements, but I don't see any real urgency to do so. And as a result of that, I think that that's probably going to hurt Apple's stock performance. And certainly the chart is indicating that as well. You have a head and shoulders type pattern. We have a strong sell-off. This is a very bearish, we call this a bull kicker bar or a bear kicker bar. The bears kicked the bulls in the butt and kind of knocked the price of the stock down. Apple has already broken below key support. These are all bearish indicators in the market. And so goes Apple, so goes the market, right? So we got MSFT, Microsoft. Microsoft also taking it on the nose, already at key support, far more bearish than the rest of the markets. Microsoft has been a real strong leader in the market for quite some time. We also have, I'm going to just go into another one of the major technology companies. We have AMD, AMD also at key support. So you have all your tech leaders now showing weakness. I'm going to go to the big one. This is the real Facebook, let's take a look at Facebook. I mean, this stock, was a darling of the market for a long time, right? So let's just make sure that this is Facebook. This is Facebook. I mean, this is not a healthy looking chart. If Facebook breaks down from here, it's kind of stuck in a consolidation pattern. I mean, it's down from 345 down to, under $200 a share. I mean, that's pretty bearish. That's a pretty bearish looking chart if it breaks down. It looks like a possible continuation play to the downside. Amazon also in a downtrend on the weekly chart. These are tech leaders. They have led the market rally in the last 12 years, and they are all looking pretty bearish. Conversely, let's look at the old man, as we like to call him, gold, right? Gold is not doing so well either. So strangely enough, you would expect that gold might be a place where some currency would go to, some money would go to hide. Gold also looking like a bearish downtrend. We could let's take a look at GBTC. Bitcoin, obviously coming off the lows. This is the ETF that represents Bitcoin, and it is at its low, at its recent low. So Bitcoin, not doing badly in the face of Ethereum, but certainly not moving up on the news. Ethereum slightly better than Bitcoin, but also near support. So again, Ethereum and Bitcoin trading with the tech sector. I'm looking at which is Visa, which is a payment processor, and Visa broke the low. Let's take a look at MC, or it's actually MA, right? MasterCard breaking the low. I mean, these are all key indicators of the economy, and not a one of them look very, very healthy, which is not a great signal for the markets overall. When all of your major players in the market, have a pretty unhealthy chart. Now, on a different note, here's ExxonMobil, not a really big performer in the last couple of years, but certainly way off its lows and kind of near the prior high that was established at the start of the Ukraine-Russia war, as ExxonMobil and some of the oil companies are faring, a little bit better. Oil and gas certainly doing better than some of the other companies out there. Just to take a look at a different sector, JP Morgan, that we don't look at too often, JP Morgan, doing okay. It's kind of stopped its downward decline. JP Morgan is the largest bank by deposits in the United States. Citibank, also kind of stable, but has a little bit more of a bearish chart than JP Morgan. Some old standby stocks like Ford kind of looks healthy. It's kind of made a bull pennant formation or a bull flag formation, but it's holding there at the $14 level. So we have a lot of different indicators saying bearishness with some of the more defensive companies like ExxonMobil, or the old standby companies such as ExxonMobil and Ford looking a little bit more healthy. One thing I would like to take a look at is USO, right, which represents oil, the actual oil contract. We have seen a real drop in the price of gasoline, since I guess about 2 months ago. And I would really caution people that the price of oil probably and gasoline would probably be expected to increase in about a month and a half time. This is a really well-established cyclical pattern that as you go into the end of the year, you have a precipitous increase in the price of gasoline and the price of oil. Not only that, you have some certain political dynamics that are at play here as well. We have uncertainty related to the midterm election. You certainly, any incumbent political party, would do everything they possibly can do to make sure that the price at the pump is low as possible going into, any kind of election. And we're going into the midterm elections on November 4th. So as we get closer to election day, I would say you're probably going to see these oil prices hold, but I wouldn't bet on them anything after mid-November, as that is the time when cyclically oil prices and gasoline prices are set to increase. So I certainly would wouldn't expect things to, to be too different. Now, I would say that the overall strength of the US dollar has certainly helped keep the price of oil low. It certainly has depressed price of gold, which is the old man. And at some point, you're going to see a reversal of that trend. And you probably got about a month's time or a month and a half's time before you can expect that to kind of set in. Now, two other things, you're going to see a strengthening of the dollar because you have a 0.75 basis point rate hike set for September 21st. And then you have another one coming into, probably end of October, early November. So with two 75 basis point, rate hikes expected, you're going to see the commodities that are denominated in dollars, such as oil and gold, and you're going to see anything. You're going to see the stock markets, which are denominated in dollars, on depressed to the downside, and you're going to see obviously the dollar strengthening to the upside. So it's a really good time to be in the dollar as interest rates are rising. And of course, it's not a good time to be in anything that's inverse to the dollar. And that's certainly why we see these price drops that are occurring in oil, gasoline, gold, the stock market, technology sector, Bitcoin, Ethereum, which again are all denominated in dollars. They're priced against dollars. So that's part of the reason why we kind of see everything moving in concert to the downside. Needless to say, with that all being said, let's get out of the charts and wrap this up for yet another week of the Dash Trader Newsroom. And let's just jump to our slides. And we are just about halfway through our number one best trader registration. Registration is now open. The DAS is teaming up with the Nasdaq to offer our swing trading competition. Registration and boot camp September 5th to October 2nd. Competition runs for 20 trading days, October 3rd to October 28th. That's 20 trading days. You can hold overnight positions. You get the prizes include up to 9 months of access to the Dash Trader Pro platform. All winners will receive a private tour of the Nasdaq market site in Times Square. Visit Number One Best Trader to learn more. For full details, just go to onebesttrader.com. Stay up to date with all things DAS by signing up for our monthly newsletter and emails. Fill out the form at the bottom of our webpage at dashtrader.com. Subscribe to our YouTube channel at Dash Trader TV and the Dash Trader Newsroom reminders as one of the playlists. Follow us on all of our social media outlets, which is on LinkedIn, Twitter, Facebook, and Instagram. Thank you so much for joining us, and look forward to seeing you all in 2 weeks, and look forward to seeing you in the Number One Best Trader competition. Thank you and have a great weekend.